Good morning, dear subscribers. Let's see if we can make any sense of the price action of last week. We certainly didn't have a good week, but hopefully we are coming to some clarity as to what is going on. You always need to lose a little bit of money to prompt you to think harder. Anyway, let's review the fixed income markets like we always do and have a look at our bands in the 2-year. This is the bullish band, this is my God help band, and this is the neutral band. We don't know, the Fed might raise rates a little bit, or they might not. And this is the bearish area where people start thinking, oh my God, the Fed's going to raise and keep on raising forever. Where are we? Well, we are very close to the panic area. We are just below we closed just below the panic area line, we would say. The same is true for the 5-year note, so we won't look at it, but in the 10-year note we are getting to the panic area. This would be the neutral area, this would be the bullish area. Things are going deflation, we are worried about it, and this is deflation, we are definitely worried about it. What is going to happen here? Well, with non-farm payrolls coming out on Friday, chances are and this being a shortened holiday week, chances are that not a lot is going to happen. We would anticipate that the market might test this lower area around 132.20 to 132.16, but that it will not break it, certainly not before non-farm payroll, and even after non-farm payroll, unless it's an incredible number. We think the market is going to be incredibly well supported at these areas. The one that's really standing out is the 30-year. The yield curve keeps on flattening, and most dramatically in the 10 to 30-year sector. This is to us the clearest indicator of what should be our worldview, which we will explore later. This is just such a bullish chart that we have no words for it. Let's have a look at a weekly chart. Well, some might argue that we are at the top of a very, very large wedge or whatever, or we're spiking through the trend channel. Yeah, we're not so sure, and we will give you our reasons later. We think that this is now the be-all and end-all of all markets, and we will explain why in a moment. Moving on to Europe, well, really they haven't moved a tick from where they closed on Monday after Brexit. The Brexit shock basically just lowered yields, and the market just traded up and down within a very narrow band. Those were the Schatz. Let's have a look at the Bund, same story. Traded within a very narrow band within the first shock movement in yields. It tried to close the gap. It failed. We think it might try again to the downside, probably fail, and then we shall see, but it's colored, and we will explain to you what our new macro view is, so you can deduce for yourselves where this is going in the long term. but certainly nothing here for the short term. This is the weekly. We are right at the top of the Bollinger Bands. Chances are that we have a quiet week waiting for non-farm payrolls and the next move. So we are in basically a consolidation phase over the next few days before we have a sizable move either way. Just to continue the review before we start thinking longer term, let's have a look at what the dollar is doing on a daily basis. It's basically consolidating and bear flagging, or it's made a base and it couldn't break through the yearly pivot point, which is right here at around 110.50, which could be judged as bullish in the long term. But before we can get bullish, we really need to take out this 112.50, 112.70 area and stay above it for a considerable period of time. To us, this is just shorts getting out the market and thinking again. The one which is the most interesting is, of course, euro against sterling, which has now broken through the top of this very important channel resistance line. We now anticipate that this will certainly trade around between 90 and 95. It's a buy on any dip, and we shall certainly be doing that in the next few weeks and days. Just to show you how important this trend line is, it goes back all the way to 2000 and has held the market until the extreme weakness of the euro, and now it's holding the market again. You can see how well it's been reacting off it. We are very overbought, of course, short term, and we are through the Bollinger Bands, but we're not that far away from the longest moving averages. This is a 200-week moving average. So we would expect any 1 to 2% dips now to be bought quite aggressively. And the yen, which is the one which is puzzling us the most, we can see that all we're doing is hugging the lower Bollinger Band on the weeklies, which is probably the most bearish scenario there is. We still expect reactions up to 105 to 107, maybe 109, but these reactions will be caught by the moving averages, which have now very much turned over and are plummeting. So we now expect any risk on kind of rally in yen to in dollar yen to be caught at a much lower level than we previously anticipated. Now we don't think it goes above 108 and a quarter, and that is going to be pushing it some. Let's have a look at what the equities did. In the US, well, we know what happened. The 0.382 retracement held and the squeeze started. What can we learn from this? From this we can learn several things. This is an hourly chart, and this is why we weren't bearish down here, but we thought of buying it. We had that 2085 bid which we pulled because we bottled it basically. Sorry, 1985 bid. This is what was worrying us. Huge divergence. And this is what's worrying us now. Huge divergence again in the MACD. Look where the market is. Look where the what the MACD is doing. Huge negative divergence. We're just pointing out what the situation is. Now this is the an indicator which one of our contributors sent us, which we really like. Well, the market is now coming into overbought areas, which is nothing new. I mean, it has rallied well over 100 points since the low. We're not actually saying anything that's incredibly intelligent here. But what it's telling us is that any dip is going to be quite shallow. We certainly wouldn't anticipate that the low over the next few days is going to be much below 2075 on the XPX. I think so many people were caught here and here that the market is just not going to let them get out for flat. Or so we think that the drops are going to be very shallow. We probably will only achieve very limited retracements before non-farm payroll. Let's have a look. Here we are. We certainly don't anticipate now the market dropping below 2081, which is the 0.23, let's call it. That would be our low before non-farm payroll, we think. And if we now look at the VXX, well, it could never really rally or sustain a rally above the 23.6% retracement. This is where we sold it, if you remember, and even with the whole of the Brexit kerfuffle, it really never made much of a high. It closed below that. This is a daily chart, so it couldn't manage even a single day above that retracement level, and now it's making new lows, and we think it'll certainly trade and take out these minor lows and go and touch the bottom of the Bollinger Bands, certainly the dailies, which are around 12. So continued selling in volatility we expect, which will happen just after probably a minor retracement. It won't be able to go up anymore, and then it'll just collapse into the lows. So what happened in the Europeans? Well, the Europeans are a puzzle. They just very briefly dipped into our buy box in the DAX, which is huge, and straight back up. The Bollinger Bands are very neutral, but they're still way below the longer term moving averages, which indicates to us that they will now just go up and down and maybe count for one final time towards the lows before they try to take out this 10,300 to 10,500 area. The stocks on the dailies and the weeklies spiked the bottom of the weekly Bollinger Bands and came back in. To us, that is a signal that the market just doesn't have the strength to move below the 2,700 area anytime soon, and that any dips now to 2,800 are going to be bought, and the objective is somewhere around the 3,000, 3,100 area over the next 3 to 4 weeks. Now, let's have a look at gold, silver, and the dollar, which are basically telling their own story. 1, 2, 3, 4, 5 weeks in succession higher, closing just below this all-important trend line. And here we have a market which is going parabolic. 1, 2, 3, 4, 5 weeks, the same as gold. Still a long way away from an important trend line, but it's basically broken all these other short-term trend lines that we had drawn before. There's really, if you draw it from here to there, it's just ridiculous, 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 ridiculous. So it's broken everything. If you now draw some others, say you take it from this point to that point, well, it's gone. There's absolutely nothing apart from that last trend line to aim at, which comes in well over 21, which comes in at these levels, and then it will be building some kind of very large inverse head and shoulders over time. So I'm afraid silver we have to be bullish of, however much we hate it. And let's have a look at the weekly, because we're now going into a very much longer time frame. Dollar index. Just like the equity markets, there is compression now in the Bollinger Bands. It couldn't sustain the move above the center, above the 50-week moving average. 200 is still rising nicely, which tells us that the dollar index is still not ready for a breakout. Since now everybody is long, chances are that we go and trade somewhere around this area, the 94 area, and stop everybody out, which would make sense because the euro is looking quite neutral. So we just basically stop all the people who bought it out, and then in many weeks time maybe try the upside again, but we shall explain that why we think that is actually becoming less and less likely. Oil, it just won't go down. It is now basically just correcting these moving averages. It'll spend a bit more time between the 54 and 44 area, so we're now in a big trading range before we actually try and break higher, we think. So we're certainly buyers of commodities on dips, and this is basically what the commodities have been doing over the past few weeks. Nothing. 1, 2, 3, 4, 5. Let's put it 1, 2, 3, 4, 5, 6 weeks. Nothing. And given that yields have fallen so much over the past 6 weeks, that is actually not surprising. The commodity markets are being held up by the lower yields. And now let's look at the most incredible chart, we think. This is actually courtesy of Chavaco Capital, so we want to give him the credit for it. We certainly look at this, but he has put it very, very succinctly. This is the NYSE divided by TLT, which is long-dated treasuries. In a week where the stock market rallied the best part of 4%, this ratio fell. That is incredible to some. It's not incredible to us. As we said after Brexit, buy bonds. We just didn't think of buying 30-year bonds. We bought 10-year bonds and then switched it into 5s and just faffed around. Well, we've learned a lesson. We should have just stuck with our view, buy bonds. Basically, what this tells you is that in a week when equities rallied 4%, long bonds rallied more. And look at this chart. I mean, how bearish is this chart? You have a succession of lower highs and a succession of lower lows. This is a very bearish chart, which actually tells you all you need to know, which is that equities are being held up by lower bond yields and will continue or not to be held up by long-term bond yields. Look at the S&P dividend yield. The S&P dividend yield is now 2.8%. Let's call it 210 between friends. This is the 30-year bond. It's yielding 2.25%. And have a look at the shape of this chart. If it takes out in a few weeks' time, because we would expect some consolidation at these levels, if it takes out 222 on a closing basis and say it closes below 220, its chances are it'll just collapse. And that is what will support the equities in our view. The same for 10-year notes. They're just in, they might trade back up to 160, but who cares? They're a buy and they're going towards 1 without much question in our own mind. Have a look at the German 30-year note, 30-year bond. 0.39%. So there's a 2% differential nearly between Germany and the States. This is the first week that the German Bund, the 10-year, has spent wholly below 0, having broken the previous lows around 6-7 basis points. Look where we were a year ago, close to 1%. We have retraced all of those gains and gone negative now, and we're staying negative. Well, what is going on? Well, we'll tell you what we think is going on. Well, this is what we think is going on. Have a look at the assets of the private pension funds in the world. What do pension funds do? Well, basically you keep on paying into it while you're working. They invest it mostly in equities. Hopefully the equities rise in value, and then when you retire at the age of 65, they take the equities, sell them, and with the proceeds buy a 30-year bond or a 20-year bond or something long-term in any case, which will pay you your monthly income while you are retired. You retire at 65, average age expectancy around 68, so you buy something around a 15 to 20 year, something like that, and at the end of that period you've hopefully lived off the income, that's the supplemental income that is provided over your state pension, and then you have something to pass on to your children, i.e. the principal of your pension. Or you can just draw down every year an incremental value of your nest egg to supplement your expenditure. Look at the size. This is in end of 2014. Now it's risen to approximately 40,000 billion US dollars. When you compare that to the balance sheet of the Fed, well, that's roughly 10 times the balance sheet of the Fed. So this is what the Fed has bought during QE, and it's 10% of what the pension funds hold. Let us now have a quick look at a spreadsheet that I've prepared, just showing you what a complete mess we are in now after only 6 months of price action. Let's take a very, very, very fortunate baby boomer who is about to retire, and he has an equity of a full $1 million. That is not even, we wouldn't estimate even 10% of the baby boomers who are currently retiring who have that kind of nest egg. Nearly 45% have almost no assets whatsoever. So you can see how optimistic this figure is. Well, let's have a look what's been happening over the past 6 months. On the 1st of January 2016, the S&P was to 2030, which would have bought him 492. With that million, he would have bought 492.61 units. Now, on the 1st of July, that value is 2,102, let's call it. So his pension has gone from, his nest egg has gone from $1 million to $1,035,000 US dollars. But the long bond yield, which he has to buy to provide him his monthly income, has gone from a yield of 3%, providing him with a yearly supplemental income of $31,000, to 224, providing him a supplemental income of $23,000. He has lost a full 25% of his future supplemental income over and above his entitlement pension, i.e. his state pension. State pensions are basically set at almost poverty levels. Now let's have a look at what this means for somebody who is in Germany or in the EU. Again, $1 million at the 1st of January foreign exchange rates. This is the value of the DAX. So his value has actually fallen from 921,000 euros to 838,000 euros. And at the same time, the long bond yield in Germany has fallen from 141 to 0.4, which basically means that his potential yearly income has gone from 13,000 euros to 3,000 euros, which basically means he can afford to go to the restaurant once a month. He has lost a full 75% of his future income over and above his entitled pension, which is tiny. Even in dollar terms, instead of losing 74%, he's lost 73.5%. Big deal. What does this mean? This means that he has absolutely no option but to start drawing down on his nest egg. He can basically draw down 30,000 euros a year from his nest egg, and by the time he dies there'll be nothing left to give over, to leave to his children. Now let's reduce that to a sensible figure. Let's call it 250,000. So it's still quite high by an average. The average has to be a lot lower. Look at now how much he can, the guy in the EU, what he can do with his drawdown. Nothing. He can go on holiday and leave nothing to his children. Or he can swap it for dollar yield, and from a yearly income of 800 euros convert that to a yearly dollar income of $5,250. We think that that is more and more likely to happen, and that European retirees will more and more invest in the US and less in the sclerotic Eurozone. This is a humongous change and will have a huge effect on the markets. The UK, the Netherlands, don't forget that this figure for Germany and France only has the corporate pension plans. When you include the private pension plans, this figure rises significantly. We are seeing amounts which are in the order of magnitude of 3-4 times as much as the Fed has done in QE, potentially coming to the bond market, because now there is no alternative. None. This is the balance sheet of the Fed, 4,000 billion. This is the balance sheet of the pension funds, which over the next few years, every year, a large part of it, a certain percentage of it, let's call it 5 to 10%, is converted into bonds to provide for income for retirees. And that is absolutely swamping this price. And as it swamps the 30-year bond, so these lower yields are supporting the equity market and giving us this chart, which is still bearish, but let's hope that it stabilizes at these levels and that just zigzags around here. What does that mean? That means that it's not risk on or risk off. It's where is the long bond? And I'll give you the price of equities. That means you either buy both or you sell both. All this easing QE has now triggered a pension disaster. What is going to happen to people who now see their pension income significantly dwindle? It is going to produce a reduction in consumption. People are going to be feeling less well off rather than better off because of the higher equity prices. This is again the Blue Angels. It is now very much supported at 16 times, which is around the 2020 area. We really wouldn't be surprised in the next few months to see it rise towards the 17 times area, which was roughly around the 2150 to 2170 area, simply because bond yields keep on going down. What impact does that have on sectors? Well, we've been puzzled by the inability of the consumer discretionary area to rally and keep pace with the other indices, which we'll show you in a second. We think that is what's going on. Consumer discretionary, luxury products, etc. are going to have a very, very, very tough time as millions of retirees have less money, less disposable income over the next few years. And we think the stock market is beginning to discount that. While the consumer staples keeps on rising and going through ridiculous valuation levels, well, they're only ridiculous against the long-term averages. If now long bond yields are going to go to 2% and below 2% and stay below 2% and possibly approach the levels seen in Europe and now in the UK, where the long gilt yield closed below 1%, you will see why consumer staples, which are the most defensive sector, is actually the most highly valued and will probably continue to be the most highly valued. We won't talk about energy. You know what we think about energy. It's going to take years for this to go back to sensible levels. So we are just not buyers of energy. We'd much rather trade oil. And this is again the one which is the most bearish. Financials just cannot come back to the pre-Brexit levels. The lower the yields, the lower the flatter the yield curve, the less money the financials can make, and therefore they are actually doomed. The financial index is the one that is the most bearish against the average of the S&P. Healthcare is nowhere near as bearish as financials. So basically what we are suggesting is a butterfly between consumer staples long, healthcare long, and financials short. and that is what we will be doing for ourselves. The reasons being very simple. People must buy healthcare. Okay, they will buy them marginally less medicine and suffer marginally more, but there's only so much of that you can do. There's only so much that you can cut on food, but you can really cut down on discretionary spending, and you can really cut down on financial services. So financial services bearish, consumer staples bullish, even though they're ridiculous valuations. Consumer discretionary bearish, and the index will probably spike this time 17 line, simply because the bond market will make it spike. We think we're going into a new era where it's not risk on or risk off, i.e. sell bonds, buy equities, but either buy both or sell both. And that is the major change. What implications does that have for the price of gold? Well, we think it has profound implications in the very, very long term. Unfortunately, in a situation where you have a significant portion of your population deprived of their dream, i.e. their retirement, you're going to have a situation where they downsize very rapidly. What will they do? They will sell their house in the suburbs. They will, instead of owning a $1 million home, they'll own a $200,000 flat, apartment. That's what they're going to do. That is how they're going to try and surmount this loss of monthly income which is being forced upon them. That will lead to more extreme politics, without a doubt, and more volatility in the political scene. And that is all music to the ears of the gold bulls. This is still by far the best, how shall we say it, store of value in uncertain times. We fear that we are forced to own some gold in our retirement accounts, whether we think that the value is now or in 10 years' time. We basically don't care. What we are saying is that the meteorological office has just put out a hurricane alert, and the price of home insurance has only gone up by 10%. Well, we'll take out some home insurance. We are hoping that the hurricane won't hit us, but there's a warning out there, and if it does hit, it's going to pay off times 10. And if the hurricane doesn't hit, well, thank God for that, and we will have lost the money that we put up for the hurricane insurance. We no longer think it's prudent not to own some kind of hard asset like gold for the very, very long term. We shall definitely come back to these themes, but we certainly think that some kind of long-term thinking into owning long-term bonds and gold is warranted here. I'm sorry that we talk so much about the longer term perspective rather than concentrating on short-term trading, but we think that we're seeing something which will be the theme for the next few years as opposed to the next few weeks. And we will continue to come back onto this theme and see what our path is from week to week. Thank you.